Everyone's freaking out over a 50% drop, but that's not the real problem. The truth behind Bitcoin's move is far more shocking than the number you're staring at. Right now, as I'm recording this, Bitcoin is sitting around $66,000. 4 months ago, in October 2025, it hit an all-time high of $126,000. We're now nearly 50% below that peak. In the last 30 days alone, Bitcoin has dropped roughly 28%. And in early February, it briefly touched $60,062, the lowest we've seen in about 16 months. So yes, the chart looks brutal. But here's the question most people never ask. What is actually driving this? Not the headlines, not the tweets. What are the real forces behind this move, and what does that tell us about where we might be headed over the next 1 to 3 months? Because I can promise you this, if you don't have a framework for understanding what's happening right now, you're going to keep reacting to every headline, every pump, every dump, and you will always be late. You'll buy high because everyone else is excited, and you'll sell low because fear is contagious. The only way out of that cycle is to understand the mechanics. Not to predict the future, but to see the game clearly enough that you stop being surprised every time something moves. Let me start with the mood in the market, because it's actually telling you more than the price itself. There's a gauge called the Crypto Fear and Greed Index. It runs from 0 to 100. 0 is maximum fear, 100 is maximum greed. On February 6th of this year, that index hit 5 out of 100. That is the lowest reading in Bitcoin's entire history, lower than the FTX collapse in 2022, lower than Terra Luna, lower than anything we've ever seen. As of February 12th, it had recovered slightly to 11, but we are still deep in what the index calls extreme fear. Now, does that mean you should buy? Not necessarily. Does it mean you should panic? Also no. What it means is that the emotional state of the market right now is about as bad as it gets, and that context matters for literally everything else I'm about to tell you. So what actually brought us here? Because this wasn't random. There were specific events, and understanding them is the difference between being confused and being prepared. The first big trigger was January 30th. President Trump nominated Kevin Warsh to be the next chair of the Federal Reserve, replacing Jerome Powell when his term ends in May. Warsh is what you'd call a monetary hawk. That means he generally favors higher interest rates and tighter financial conditions. Bitcoin dropped about 6 to 7% the day that news hit. Now, why does a Fed chair nomination move Bitcoin? Most people don't think about this, but Bitcoin, especially in the eyes of large institutional investors, has increasingly been treated like a risk asset, similar to tech stocks. When the financial environment tightens, when borrowing money gets more expensive, big investors pull back from riskier bets. It's not personal. It's not even really about Bitcoin. It's about capital allocation in a changing macro environment. The Warsh news was a signal that the easy money era might be ending sooner than people thought, and the market reacted accordingly. Then came early February. Bitcoin was already under pressure, sitting in the low to mid 70,000s. On February 5th and 6th, it dropped about 15% in a single day, touching that $60,000 level. A few things hit at once. Investors who had borrowed money to bet on Bitcoin, what's called leverage trading, started getting liquidated as the price fell. When you borrow money to trade and the price moves against you, the exchange automatically closes your position to protect the lender. That forced selling creates a cascade. According to data from Coinglass, over $2.5 billion in cryptocurrency liquidations happened in just 24 hours on February 6th. VanEck estimated $2 to $2.5 billion in Bitcoin futures liquidations specifically. At the same time, U.S. tech stocks were selling off hard, and Bitcoin has increasingly moved in lockstep with the tech sector. The market bounced sharply on February 7th, up about 11% in a day, but it couldn't hold. Right now, Bitcoin is stuck in this choppy, uncertain range between roughly $65,000 and $72,000, and the market is trying to figure out what comes next. Here's where it gets interesting, and this is the part that most people completely ignore. Behind the scenes, there's a story unfolding with the Bitcoin ETFs, the exchange-traded funds from companies like BlackRock and Fidelity that let regular investors and institutions buy Bitcoin through a normal brokerage account. These ETFs were a massive deal when they launched. They pulled in roughly $35 billion in annual net inflows in both 2024 and 2025. That was a consistent source of buying pressure for Bitcoin month after month. That dynamic has reversed. From November 2025 through January 2026, U.S. Bitcoin ETFs saw approximately $6.18 billion in net outflows. Goldman Sachs cut its Bitcoin ETF exposure by nearly 40% in the fourth quarter of 2025. These aren't retail investors panic selling. These are massive financial institutions reducing their positions in a deliberate, calculated way. On February 11th alone, Fidelity's Bitcoin ETF saw $926 million flow out in a single day. That is an enormous amount of selling pressure. There was a brief bright spot on February 9th and 10th, 2 consecutive days of net inflows totaling about $616 million. That was the first back-to-back inflow in nearly a month, and some analysts saw it as a tentative sign that institutional buyers might be cautiously returning. But then came another day of outflows on February 11th, a quick reminder of just how fragile this recovery attempt really is. But here's the twist, and this is where the story splits in two. While ETFs were bleeding and retail investors were panicking, something very different was happening on-chain. On February 6th, the same day the Fear and Greed Index hit that all-time low of 5, the day of maximum panic, on-chain data from CryptoQuant showed that roughly 66,940 Bitcoin flowed into what are called accumulation addresses. These are wallets associated with large buyers who move Bitcoin in and don't move it back out. At around $67,000 per coin, that's approximately $4.5 billion in Bitcoin being quietly absorbed by large holders on the single worst day in terms of market sentiment. Separately, Glassnode confirmed that wallets holding over 1,000 Bitcoin added more than $4 billion in exposure in the week following the crash. Think about that for a second. While most people were selling in fear, some of the biggest players in the world were buying at scale. This is a pattern that has shown up historically near market lows. Does it guarantee we've bottomed? Absolutely not. Does it mean the worst is over? I have no idea. But it is a real data point, and it tells you something important. Not everyone is reacting the same way. The people with the most capital and the longest time horizons are behaving very differently from the crowd. If you value this kind of no-drama breakdown of what's really happening with Bitcoin, consider subscribing. I'm not here to sell you hopium or fear. I'm here to help you see the mechanics, so you're not guessing every time the market moves. Now let me talk about the miners, because they're under serious stress right now, and that stress is affecting the entire market. Miners are the companies and individuals who run the computers that process Bitcoin transactions and earn new Bitcoin as a reward. According to data from CoinDesk and CheckOnChain, the estimated average cost to mine 1 Bitcoin across the industry right now is approximately $87,000. Bitcoin is currently priced around $66,000. That means miners are, on average, operating at a 20% loss relative to their production cost. To make things worse, a major winter storm in early February forced mining operations in Texas and other states to shut down temporarily. The result was that Bitcoin's network computing power dropped roughly 20% from its all-time high, and the network's automatic difficulty adjustment, which makes mining easier when fewer computers are running, dropped by about 11%. That's one of the steepest single drops since China banned Bitcoin mining in 2021. When miners are losing money, they have no choice but to sell their Bitcoin reserves to cover operating costs. According to CryptoQuant, an estimated 24,000 to 28,000 Bitcoin was transferred by miners to exchanges on February 5th alone. That's one of the largest single-day miner selling events on record, and it hit right at the worst possible moment, adding fuel to an already panicking market. The silver lining is that the difficulty adjustment should gradually make mining viable again for the operations that survived, which could reduce this forced selling pressure going forward. Now let's talk about the regulatory picture, because it's actually a lot more constructive than most people realize, and this matters for the bigger story. In July 2025, the US government signed the Genius Act, the first major federal law specifically governing crypto. It created a clear framework for stablecoins, which are dollar-backed digital currencies. By late 2025, the stablecoin market had grown to over $250 billion. The significance here isn't just about stablecoins. It's a signal that the US government is choosing to regulate and legitimize the crypto industry rather than ban it or push it offshore. There's a second piece of legislation called the Clarity Act that passed the House in July 2025 and is currently stalled in the Senate. If it passes, it would clearly define Bitcoin as a commodity, not a security, eliminating a huge amount of legal uncertainty for banks and institutions that want to hold or offer Bitcoin products. VanEck's research team estimated that this single piece of legislation, if it clears the Senate, could potentially unlock $50 billion in new institutional inflows by mid-2026. That's not a small number. So what do the next 1 to 3 months actually look like? Let me walk you through 3 realistic scenarios, and I want to be very clear. These are possibilities grounded in real data and analyst opinion. They are not predictions, and none of this is financial advice. I'm just laying out the paths I'm watching. The first scenario is continued consolidation. Bitcoin stays in a rough range between $60,000 and $80,000 for the next 1 to 3 months. The panic fades, but there's no powerful catalyst to drive a big rally either. ETF flows remain inconsistent. The Warsh confirmation process creates ongoing uncertainty, and the market just chops sideways while it digests everything that's happened. This scenario becomes more likely if tech stocks stabilize, miner selling eases off, and the on-chain accumulation we're seeing continues to quietly reduce available supply. If that's the path we're on, I wouldn't be surprised to see Bitcoin spending most of its time in the $65,000 to $72,000 range in the near term. The second scenario is a deeper pullback. This is the bearish case. If Bitcoin breaks convincingly below $60,000, that key psychological level, it could open the door to further downside. Stephen McClurg, the CEO of Canary Capital, told CNBC on February 11th that he expects Bitcoin to fall as low as $50,000 by summer before recovering in the fall. Marcus Thielen from 10x Research mentioned the same 50,000 level as a real possibility. The factors that would push us there include a return of heavy ETF outflows, hotter than expected inflation data making Fed rate cuts less likely, or a sharp drop in U.S. tech stocks dragging Bitcoin down with them. This scenario would be painful, no question. But for context, a $50,000 floor would still be a far shallower decline than what we saw in 2018 or 2022, when Bitcoin fell 80% or more from its peaks. The third scenario is a meaningful recovery. This is the bullish case for the near term. Bitcoin stabilizes in the $65,000 to $70,000 range and then rallies back toward $80,000 to $100,000 by April or May. What would drive this? A sustained return of ETF inflows. Those two back-to-back days of positive flows on February 9th and 10th could be an early signal. Progress on the Clarity Act in the Senate. Any indication from the Federal Reserve that rate cuts are more likely, or simply the whale accumulation at these levels creating a supply shortage over time as fewer coins become available to sell. VanEck's research team also pointed out that Bitcoin's price is currently more than 2.5 standard deviations below its 200-day moving average, a level we haven't seen in the last 10 years, including during COVID and the FTX collapse. Statistically, moves of that magnitude have historically marked exhaustion of selling rather than the beginning of more downside, though of course there are no guarantees. There's one deeper question underneath all of this that's splitting analysts right now. Is Bitcoin still following its historical 4-year cycle, where it peaks after a halving event and then spends about a year declining before recovering? Or have ETFs and institutional capital changed the game enough that the old cycle framework no longer applies? Stephen McClurg at Canary Capital argues the cycle is still intact and that 2026 is simply the bear year, with recovery coming in 2027. But others, like analyst Nick Puckrin of Coin Bureau, believe that Bitcoin's future will be driven by macroeconomic and geopolitical forces, not time-based patterns, and that the old cycle models are becoming less reliable guides than they used to be. Here's what I think matters most for you as someone who treats Bitcoin as part of your personal finances, not as a lottery ticket. The single most dangerous thing you can do right now is make big decisions based purely on how you feel. The fear and greed index hitting 5 tells you that the emotional environment is as bad as it gets. Historically, those moments of maximum fear are exactly when the clearest thinking is most valuable, and they're also exactly when it's hardest to achieve. That doesn't mean you should blindly buy just because things are scary. It means you should have a framework in place before the chaos hits, not build one while you're panicking in reaction to a headline. Understanding what is actually driving the price, the macro environment, ETF flows, minor stress, regulatory progress, and large holder behavior gives you something solid to anchor to. When you see a scary headline or a big red candle, you can ask yourself a very simple question. Does this change the long-term fundamentals, or is this just noise? That question is infinitely more useful than refreshing the price chart every 5 minutes. Whatever you decide to do with your own money, and I mean this, please make that decision with a qualified financial professional based on your own situation, your own risk tolerance, and your own time horizon. What I can offer you is the clearest picture of the data I can find and a framework for making sense of it. The decision of what to do with that information is entirely yours, and it should be made deliberately, not emotionally. If this kind of breakdown helps you think more clearly about Bitcoin, I'd really appreciate it if you subscribed. No hype, no drama, just the data and the context you need to make better decisions. Everyone's freaking out over a 50% drop. But that's not the real problem. The truth behind Bitcoin's move is far more shocking than the number you're staring at.